Last week, we heard from two of the nation's largest home builders, Lennar on Monday and KB Home on Tuesday. And they told an interesting story. The home builders are a really fascinating group right now. These stocks started rallying just over 2 years ago, with the SPDR Homebuilders ETF more than doubling during that period. And that's not supposed to happen when the Fed's ratcheting up interest rates, making mortgages much more expensive. But this time was different because we got a huge housing shortage going on here. Meanwhile, rates came up so rapidly that existing homeowners won't sell because then they lose their ultra-cheap mortgages from the age of near zero interest rates. That means new homes are often the only game in town. But how long can that last? The home builders started the year strong again because Wall Street initially figured we'd get maybe 6 rate cuts this year. But as it became clear that we might get 1 rate cut, at best, the group stalled out. The Fed's higher for longer stance it's really taken a toll here. Homebuilder sentiment's been worsening, and investors seem unsure about what to do with the stocks.
Buy. Don't buy.
Which is why we were watching these numbers so closely from Lennar and KB Home. So what happened? Well, Lennar reported on Monday night, and you know what? The market hated it. The stock fell nearly 5% the next day. But when KB Home reported Tuesday night, we saw a very different reaction. Its stock jumped nearly 3% the next trading day. So why did Wall Street hate one and love the other? Let's start with the Lennar quarter. The actual results were good, a clean top and bottom line beat, but there were 2 problems here. First, Chairman and co-CEO Stuart Miller provided a quote with the earnings release where he used a very bad word. He said purchasers remain responsive to increased sales incentives. Oh boy, incentives. That's not what you want to hear, incentives. That's why Lennar's average sales price of homes delivered was $426,000, down from $449,000 the year before. That's a big decline. Make matters worse, the company gave you a mixed outlook for the current quarter. Lennar's new orders guidance came in a little light, and their expected average sales price for deliveries was a bit below the consensus estimate. Worst of all, management said they'd earn $3.50 to $3.65 per share in the quarter when analysts were looking for $3.96. Wow. Ouch, particularly because this company has been beaten and raising for I don't know how long. Lennar also provided an update on its idea that it's been floating for a while now, the potential spinoff of some of its land assets into a separate entity. They're now planning a $6 to $8 billion land spinoff in order to become a little more asset light, and they said they made substantial progress over the past 90 days in doing so. Not everyone loves this idea of this spinoff because, well, in part because it seems to indicate that maybe Lennar's less bullish on the durability of housing demand, and in part because there's a lot of uncertainty about how this thing would play out. So that's why Lennar sold off. But why did KB Home get so much love? Like Lennar, KB Home gave us a robust top and bottom line beat. Unlike Lennar, KB Home, their average selling price increased. Oh, okay, just slightly, but it still increased 0.7% year over year, coming in slightly better than expected. In terms of KB Home's guidance, the company anticipated housing revenue was just slightly below what the analysts were looking for, but the expected average selling price came in slightly higher than anticipated. So they're doing a much better job of holding the line on pricing, certainly more than Lennar. More important, KB Home provides full-year guidance, and it raises full-year outlook for housing revenue, average selling price, and home building operating. Boy, that's a triple play. That's exactly what we want. At the same time, it's worth noting that these guys spend a lot less time talking about the need for sales incentives to drive businesses. In the official comments from Chairman and CEO Jeff Mester, he said, quote, buyers remain resilient in their desire for home ownership despite the volatility in mortgage interest rates, end quote. There were some incentive talk on the conference call. Don't get me wrong, they did have some. But in this case, KB Home was simply lamenting that mortgage rates didn't come down because they've been hoping to remove some interest rate-related incentives. They still have to do that later this year if rates come down, ever. So let's bring this all together. After reviewing the quarterly results of both Lennar and KB Home, I'm actually more sanguine about Lennar's quarter than the market seems to be, although I also like KB Home a great deal. And, I've been predisposed to like this group for a long time. Rather than one company doing well and another doing poorly, we're simply seeing 2 different strategies. Lennar's always been clear about its strategy. It wants steady delivery numbers so that it never gets backed up with too much inventory, which is when a home builder can really get in trouble during a downturn. If Lennar needs to increase incentives to move units, they're happy to do so, because that number one priority is to keep moving units. KB Home, on the other hand, is more interested in holding the line on pricing than it is on growing deliveries. They're much less worried about getting stuck with excess inventory. It's the same dynamic we're seeing everywhere. Do you keep prices high and risk alienating your customers, or cut price and bank on higher volume to make up the difference? The fact that Lennar is seeing big increases in deliveries and an even bigger increase in orders tells me there's demand waiting in the wings if home builders offer people slightly more generous terms, or if, say, mortgage rates came down, which would really be a godsend. That's encouraging because it shows that the most important feature of the housing bull market, the structural imbalance between homes for sale and people who want to buy them, remains generally in place. We still got the housing shortage. That's the wind at our back. There were some other one-off issues that made the Lennar quarter look worse, while KB Homes look better. Lennar's land spinoff is somewhat of an overhang until we see the full details of the plan. But for now, I just say that I expect Lennar Stuart Miller can run a home builder better than practically anybody else on earth, and I trust that he'll make the right decisions. Again, what makes me like Lennar here. So even though Lennar went down and KB Home went up after both reported last week, I'm pretty positive on both stories, and the home builders more generally. While this should theoretically be a tough space if rates stay higher for longer, the housing shortage hasn't gone anywhere. But the bottom line, if we get any relief on the interest rate front, Lennar's results suggest that could bring in a new wave of buyers, which is why I think this housing bull market is far from over. Mad Money's back after the break.
Coming up, put the pedal to the metal. It's a precious off the charts with silver and gold. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.